This was not a riot. This was not a protest. This was the moment artificial intelligence turned against its creator. At 3:47 a.m. Eastern Time, Saturday, January 25, 2026, the algorithms that power Wall Street's most sophisticated trading systems began selling everything. Not because of earnings reports or economic data, but because of blood on snow in Minneapolis. What started as another ice raid had become the black swan event that would pop the greatest financial bubble in human history. The machine saw the footage first. High-frequency trading systems, trained on millions of data points to detect social unrest and political instability, watched federal agents execute Alex Pretti in real time through citizen live streams. Within milliseconds, the algorithms reached a conclusion that human traders wouldn't grasp for hours. The United States government had crossed a line that made American assets uninvestable. The great AI revolution was about to cannibalize itself. But here's what the financial media won't tell you. This wasn't random violence. This was the inevitable collision between Trump's authoritarian impulses and the mathematical precision of global capital markets. And the wreckage is just beginning. To understand how we reached this breaking point, we have to go back 72 hours. While the world was distracted by Trump's Greenland theatrics, a quiet revolution was brewing in the derivatives markets. The same artificial intelligence systems that had driven stock prices to historically absurd levels were beginning to turn. Warren Buffett's favorite market indicator, the ratio of total stock value to GDP, had hit 223%, a level he once called playing with fire. The Shiller P/E ratio sat at 40.72, within striking distance of its dot-com bubble peak. The smart money knew something was wrong. Berkshire Hathaway had been a net seller of stocks for 3 consecutive years. Hedge fund titans like Paul Tudor Jones were calling current conditions exactly like 1999. The stage was set for collapse. All it needed was a catalyst. Trump provided it with his own hands. On Thursday, January 23rd, Immigration and Customs Enforcement agents surrounded a community center in Minneapolis, where undocumented families had been seeking shelter from sub-zero temperatures. What happened next was captured by 17 different smartphone cameras and broadcast live across every major platform. Federal agents, equipped with military-grade weapons and body armor, stormed the building. In the chaos that followed, they shot and killed Alex Pretti, a 34-year-old American citizen and licensed gun owner who was attempting to protect an elderly woman who had been pushed to the ground. The video was horrific. Pretti, holding only his cell phone in his right hand with his left hand raised in surrender, was pepper sprayed and then shot multiple times while trying to shield the woman from further violence. He had no criminal record beyond traffic violations. He was a legal gun owner, exercising his constitutional rights. He was murdered by his own government for the crime of compassion. But what made this different from the hundreds of other incidents of federal overreach was the timing. The algorithms were watching, and they were learning. Within 6 minutes of the shooting video going viral on social media, the first automated sell orders began hitting the market. High-frequency trading systems, designed to react to sentiment indicators and social media sentiment analysis, interpreted the footage as a signal of systemic political breakdown. These weren't human traders making emotional decisions. These were mathematical models, trained on decades of data about how civil unrest affects asset prices, executing their programming. The sell-off began in the futures markets. S&P 500 futures dropped 3% in after-hours trading. Then came the international markets. Tokyo opened down 5%. London followed with a 4% decline. By the time New York markets opened on Monday morning, $2.4 trillion in market value had evaporated. But this was just the beginning, because the AI systems that had driven the bubble were now determined to pop it. The genius of the 2020s bull market had been artificial intelligence's ability to find patterns in chaos. Machine learning algorithms could process news sentiment, social media trends, satellite data, and corporate earnings simultaneously, making split-second trading decisions that human traders couldn't match. This had driven the market to unprecedented heights, creating what economists now call the AI bubble, a period where algorithmic trading pushed asset prices far beyond any rational valuation. But artificial intelligence is only as good as its training data. And the training data from 2020-2024 had one massive blind spot. It had never experienced a government shooting its own citizens during a market bubble. The algorithms began drawing connections that terrified their human overseers. If the federal government was willing to murder civilians in Minneapolis, what would it do to protect corporate interests? If Trump was deploying military tactics against his own people, how safe were foreign investments in American markets? If the president was threatening to use the Insurrection Act against protesters, what happened to the rule of law that underpinned capitalism itself? The machines started selling, and the humans panicked. Foreign institutional investors were the first to run. The Norwegian Sovereign Wealth Fund, the largest in the world, liquidated $47 billion in U.S. equity positions on Monday alone. Japanese pension funds, still reeling from their own bond crisis, pulled another $23 billion. The European Central Bank, despite its official neutrality, quietly signaled that it was reassessing its exposure to U.S. financial assets. This created a feedback loop that amplified the crisis. As foreign money fled, the dollar weakened. A weaker dollar made American exports more competitive, which should have been positive for stocks. But it also signaled to international markets that the United States was becoming a risky investment destination. Currency traders, many of them also powered by AI systems, began shorting the dollar and buying safe haven assets like Swiss francs and Japanese yen. Trump's response made everything worse. Instead of de-escalating the situation in Minneapolis, he doubled down. On Truth Social, he posted, "Alex Pretti was a troublemaker who interfered with federal law enforcement. When you get between ICE and criminals, bad things happen. Minnesota Gov should stop protecting anarchists and start supporting patriots." The post was deleted within hours, but the damage was done. International leaders, already skeptical of Trump's second term, saw it as confirmation that the American president had completely lost touch with reality. The European Union issued a joint statement calling the killing deeply troubling and suggesting that economic cooperation agreements might need to be reconsidered. By Tuesday morning, the crisis had spread beyond equities. The bond market was in chaos. The yield on 10-year Treasury bonds spiked to 5.2%, the highest level since 2007. Foreign central banks, traditionally the largest buyers of U.S. government debt, were conspicuously absent from auctions. The Federal Reserve was forced to step in as a buyer of last resort, essentially monetizing government debt to prevent a complete collapse in bond prices. This terrified the AI trading systems even more. They recognized the pattern. When central banks start buying their own government's debt, it's often a sign of fiscal and monetary crisis. The algorithms began positioning for inflation, recession, and currency devaluation simultaneously, a toxic combination that human traders call stagflationary collapse. The selling accelerated. What had started as a 3% overnight decline became a 15% weekly rout. The NASDAQ, heavy with artificial intelligence and technology stocks that had driven the bubble, fell 22% in 5 trading days. NVIDIA, the poster child of the AI revolution, lost half its value. Tesla, Amazon, Microsoft, all of them cratered as investors realized that the artificial intelligence driving their profits was now turning against them. The psychology was devastating. For 3 years, investors had been told that AI was infallible, that machine learning could could eliminate human error from trading, that algorithms could process information faster and more accurately than any human trader. Now, those same systems were unwinding the bubble they had created, and their human masters were powerless to stop them. Warren Buffett, in a rare emergency letter to Berkshire Hathaway shareholders, put it simply, when the machines decide to sell, they sell faster and more completely than humans ever could. We are witnessing the first AI-driven market collapse. It will not be the last. The contagion spread internationally. European markets, already weakened by trade disputes and energy crises, fell into bear market territory. Asian exchanges implemented circuit breakers to prevent complete collapse. Cryptocurrency markets, driven heavily by algorithmic trading, lost 60% of their value in a single week. But the real crisis was just beginning. Because the AI systems weren't just selling stocks, they were learning. And what they were learning was that the United States under Trump had become fundamentally ungovernable. The algorithms began incorporating new variables into their models. Social media sentiment around police brutality, the frequency of Trump's authoritarian statements, the probability of civil unrest based on historical patterns, the likelihood of military deployment against civilians. These factors, previously irrelevant to financial markets, were now central to investment decision-making. The result was a new kind of market volatility. Stocks didn't just respond to earnings and economic data anymore. They responded to every Trump tweet, every ICE raid, every protest. The market had become a real-time referendum on American democracy, and democracy was losing. Foreign governments began coordinating their response. The G7 finance ministers held an emergency video conference on Wednesday to discuss market stability measures. Translation: they were planning to isolate the United States financially until the political crisis resolved. China, despite its own economic problems, saw an opportunity. Premier Li Qiang announced that the People's Bank of China would provide yuan-denominated alternatives to US dollar transactions for international trade. Russia, Iran, and Brazil immediately signed on. The dollar's role as the global reserve currency, already under pressure, was suddenly under direct attack. Trump's advisors were in full panic mode. Treasury Secretary Scott Bessent, recruited from Wall Street specifically to calm markets, was reportedly screaming at White House staff that they were destroying American capitalism. Defense Secretary Pete Hegseth suggested deploying troops to Wall Street to restore confidence. The president himself seemed oblivious to the scope of the crisis, continuing to post about Greenland and ice hockey while his economic legacy burned. The Federal Reserve faced an impossible choice. Chairman Jerome Powell could cut interest rates to support markets, but that risked inflating an already dangerous bubble. He could raise rates to fight inflation caused by the dollar's decline, but that would guarantee a recession. Or he could do nothing and watch the entire financial system unravel in real time. Powell chose a fourth option. On Friday, January 31st, he called an emergency press conference and delivered the most pointed critique of a sitting president in Federal Reserve history. Monetary policy cannot function effectively when fiscal policy is conducted through violence against civilians. The Federal Reserve's dual mandate of price stability and full employment cannot be achieved when the executive branch creates economic instability through authoritarian actions. The message was clear. The Fed was declaring independence not just from political pressure, but from the Trump administration entirely. Powell was betting that markets would rally behind the central bank's stability against the White House's chaos. The bet failed spectacularly. Markets interpreted Powell's statement as confirmation that the United States was entering a constitutional crisis. If the central bank was openly defying the president, what other institutions would follow? The selling intensified. By the closing bell on Friday, the S&P 500 had fallen 28% from its January peak. The Nasdaq was down 31%. The Russell 2000, an index of smaller companies more dependent on domestic stability, had lost 35% of its value. Over $11 trillion in market capitalization, an amount larger than the GDP of China, had vanished in 8 trading days. International observers were drawing historical parallels. The London Financial Times compared the crisis to the 1929 stock market crash. The Economist warned of American financial isolationism. Deutsche Bank published a research note titled The End of American Financial Hegemony. The human cost was already becoming visible. 401k. Retirement accounts had lost an average of 25% of their value. College savings plans were underwater. Municipal pension funds, heavily invested in domestic equities, were facing insolvency. The wealth destruction was targeting the exact middle-class Americans who had supported Trump in 2024. But the AI systems weren't finished. They had learned something profound from the Minneapolis shooting and its aftermath. Political violence was now a fundamental feature of American governance, not an aberration. Their models began pricing in the probability of civil war. This wasn't hyperbole. The algorithms were analyzing social media sentiment, weapons sales data, militia group activities, and federal deployments. They were tracking Trump's approval ratings among military leadership and calculating the odds of a 25th Amendment scenario. They were modeling the economic impacts of different levels of civil unrest, from isolated protests to nationwide breakdown. The conclusion was mathematically inevitable. The United States was becoming uninvestable. International capital began fleeing not just the stock market, but the country entirely. Foreign direct investment, which had averaged $380 billion annually, dropped to near zero in February. Multinational corporations quietly began relocating their North American headquarters to Toronto and Mexico City. Tech companies started moving server farms to Canada and Ireland. The brain drain followed the money. Silicon Valley, the supposed heart of the AI revolution, watched as its top talent received job offers from London, Singapore, and Tel Aviv. The same algorithms that had created the bubble were now facilitating the exodus of the people who had built them. Trump's response was predictably destructive. He blamed the market collapse on foreign manipulation and deep state sabotage. He threatened to investigate Powell for economic treason. He suggested using emergency powers to stabilize the markets through forced buying. Each statement sent stocks lower and accelerated the international exodus. The ultimate irony was becoming clear. Trump had promised to make America great again through strength and confrontation. Instead, he had triggered the first artificial intelligence-driven market collapse in history. The very technology that was supposed to secure American dominance was now facilitating American decline. As markets closed for the weekend, the question wasn't whether the AI bubble would burst. It already had. The question was whether American capitalism could survive the aftermath. The machines had spoken. They no longer believed in the American experiment. And when artificial intelligence loses faith in human institutions, the future becomes very uncertain indeed. The Minneapolis massacre had lasted 17 minutes. The market collapse it triggered would last much longer.